And then I'm going to give you some sharing rights.
Okay.
All right, guys, we have Carol with us from Investors Title. She's going to tell you guys a little bit about her, but she's the guru. She's been doing these 1031 tax exchanges for a little while now. So she has a great presentation. She can answer any of your questions. And our goal is to demystify, make all of this super simple and easy so that you guys can handle all of your clients that may have these needs, particularly some of these investors right now. So without further ado, I'm going to, well, I can't let Anita in. I'm going to give you the reins.
Okay, thank you. It's nice to be with you today. Wish it could be in person, but maybe sometime in the future that will happen. I'm Carol Hayden. I'm an attorney with Investors Title Exchange Corporation. Victoria Templeton is the other attorney in our department, and I see that she's on the line as well. And we have about 11 people on our staff. As Pam said, I have been doing 1031 exchanges for about 28 years, about 24 of those with Investors Title. So we have.
Uh-oh. It might be me.
You do not need to be an expert on 1031s, but I think as real estate professionals, the more you know about it, the more you will see what kind of red flags there might be in the transaction so that you can point your clients either to the qualified intermediary to answer questions, to their CPA or a tax attorney. But the more you know about it, the less scared you'll be about the transaction and be able to recognize opportunities. There are tons of folks out there who have never heard of a 1031 exchange. And if they're selling investment property that would qualify, they will be indebted to you for life if you tell them about this opportunity. They'll be thrilled that there's a way to save taxes. And like-kind exchanges, 1031 exchanges, tax-deferred exchanges, there are many names for the transaction, but it comes from Section 1031 of the tax code. I'm going to share my screen and go through a PowerPoint presentation that goes through all the major things that I think it's most important for real estate brokers to know. And if at any time during the presentation you have a question, feel free to unmute yourself and speak up, because I'd like to make this as proactive as possible. It's not quite as easy on Zoom presentations as it is in person, but feel free to butt in with questions at any time. So let me share my screen. Let's see. Get to the right place here. Okay, can everybody see that?
Yes, ma'am.
Very good. Okay, so this is an overview. And the first thing we should consider is why a client would even want to do a 1031 exchange. And it's for immediate deferment of capital gains taxes. That's the overreaching goal. People want to defer recognition of capital gains taxes. The gain won't be recognized until an ultimate sale of the replacement property. And I sort of compare this to putting funds in an IRA. You can, within that IRA, exchange from one investment to another investment without recognizing any tax. When you draw funds out of, when you cash out of that investment and you take funds out of an IRA, that's when you get taxed. So it's sort of like this with a 1031 exchange. The whole goal is, as long as you stay invested in real estate, you're not going to recognize that gain. Only when you ultimately sell in a taxable event where you're not doing another 1031 exchange will you then recognize the gain. So the gain is deferred. Recognition of the gain is deferred. Deferment of capital gains. The taxpayer, if they decide to sell a replacement property 2 or 3 years down the road, they can do another 1031 exchange. They can keep doing exchanges forever. And it's only when they cash out of their investment that they'll ultimately recognize that gain. In the industry, we sort of refer to this as swap till you drop. And so they can keep doing it forever. And the only way to ever not recognize the gain, well, there are a couple of ways, but the main way is if you die. But as the tax code stands today, when you die, your heirs get a stepped up basis in the property that they inherit. So if there is gain that's been deferred for years and years and years and years and never paid taxes, when the taxpayer dies, his heirs will inherit that property with a stepped up basis, and there's never any gain recognition. So that sort of is a tax planning strategy people use for estate planning purposes as well. So what are exchange properties that qualify? And this is one of the biggest categories we see here in North Carolina. Somebody owns non-productive property, it's raw land. A developer approaches them and offers them $1 million for that land. And they don't want to sell because they have very little basis in this property and they're going to owe a boatload of taxes. They say, I'll just hang on to this till my kids inherit it. But if they do a 1031 exchange, they can actually convert that non-productive real estate into income producing property. And this is sort of the underlying reason why 1031 exchanges even exist. 1031 was put in the tax code in 1921. So it's 100 years old this year. And it's been around for a long time. Somebody that person who owns that tract of land sells to a developer in a 1031 exchange and acquires investment real estate that's income producing. Win-win for the taxpayer. He hasn't had to pay taxes and he's converted non-productive real estate that's not earning him any money into income producing property. It's win-win for the economy as well, because that developer is creating jobs and developing that property and putting it to use. So excellent opportunity here. Exchange into more desirable investment property. If somebody owns investment property, they may be invested in a retail shopping center that isn't very productive right now. They want to sell that and acquire multifamily. Great opportunity to do that in a 1031 exchange without paying taxes. Move the location of a business. We often see people, and this is one that people don't think about very often, but what if, for instance, a real estate firm owns an office building and they've grown and they have outgrown that building and they want to sell it and acquire a larger building? Why not do a 1031 exchange? You're staying invested in real estate. Perfect opportunity. We see this with doctors' offices, all sorts of businesses, restaurants, etc. So moving the location. Also with rental property, somebody moves here from Michigan. They owned a rental house in Michigan. It's too hard to manage that long distance. So they sell it in Michigan and buy a property here for rental. And this last one, I'll tell you a great story that I love. Leverage your equity to increase your real estate portfolio. And I think this is particularly helpful for brokers to know about this strategy that a lot of people use. My favorite story is a client that we worked with 20 years ago. She was an immigrant from Vietnam with little formal education, but a lot of smarts. And she had learned about 1031 exchanges. She owned one rental house. She had paid off the mortgage on that. She was in great shape. She decided to sell that rental house and spread the equity that she had among 3 rental houses. So she sold one property. She acquired 3 properties in the exchange. And I think the property she sold was about 150,000. She put 50 down on each of 3 properties and bought new properties that were even better, like 200 each. So instead of 150,000 worth of real estate, she now owned $600,000 worth of real estate. And she was getting better rents from the new property. She did that tax-free. If she had had to pay her capital gains tax, she would not have had as much to invest in other property. A couple of years later, she sold one of those houses and exchanged into 3. A couple of years later, she sold another one and exchanged into 3. And she ended up with about 20 real estate investment properties over the course of 8 years or so. And so it was a wonderful strategy. And of course, for brokers, that gives you multiple commissions as well. Okay. There are some reasons why someone might not do a 1031 exchange. There are additional transactional costs. Our fee is very reasonable. $850 is our normal fee. So that's not a deal breaker. There are attorney fees. Most attorneys charge extra if a 1031 is involved, either for reviewing the documents, handling that extra layer of paperwork, although we draft all the exchange documents themselves and distribute them to all the parties. There are CPA fees associated with it. But none of these are really huge fees when evaluated next to the tax savings. It's certainly worth it. And these fees can be paid out of the exchange proceeds, so the taxpayer doesn't have to come out of pocket to pay these fees. This is one of the biggest reasons a taxpayer might not want to do a 1031 exchange. And one of the reasons we recommend that they always consult a CPA if they're considering a 1031 exchange. I got a telephone call from a CPA one year that's a good friend of mine. He sends exchange business our way, but one of his clients had done a 1031 exchange without consulting him. And he called me and said, Carol, I'm not complaining at you because how would you know? But my client should never have done a 1031 exchange because he lost a lot of money last year, capital losses. And that loss would have offset his gain recognition. And he could have sold, recognized the gain, the capital losses that he had would have offset that, and he wouldn't have paid any taxes. He could have bought his new property with the proceeds, but he would have had a higher basis because that built-in gain wouldn't be built into his replacement property. So we always suggest that clients check with their CPA, check their big tax picture. You don't know that, we don't know that, but they should be consulting with their CPA. And the last thing is that there are restrictions on the access to the funds. There's an article that I wrote years ago on our website saying, I want my money now. Well, there are timing restrictions if they do a 1031 exchange as to when they can get their sales proceeds if they don't use all of it for replacement. But there's simply timing restrictions. They will get their money in at least 180 days. And they are earning interest, although interest rates are pitifully low right now. So these are the restrictions. The taxpayer can't receive their funds until, if they don't identify any property in the 45-day ID period, they can get their funds on day 46. So their funds will be held up for at least 45 days. If they do identify within the 45 days, then they can only get any remaining funds after they've actually acquired everything they identified. So if they just identified one property and on day 70, they close on that and they have $5,000 left in their account, they can get the $5,000 immediately because they've already acquired everything they identified. But if they identified 3 properties and they were alternates, they weren't sure which they were going to be able to close on, and they close on one on day 70, and they have $5,000 left in their account, we can't give them that $5,000 till the end of the 180 days because they haven't acquired everything they identified. That's an IRS rule. It's not our rule. We don't want to hold on to their money, but it could bust their exchange if we send them their money early. So that's one of the biggest jobs of the QI. And the reason the QI, qualified intermediary, even exists is to prevent their constructive receipt of exchange funds during the exchange period. Okay. So there are also time restrictions and deadlines, only 45 days to identify new property. You know how fast that goes, very fast.
Now with the market moving how it is.
Yeah, and your biggest job is, if you're involved with a client doing a 1031 exchange, is helping them identify those properties. So it's okay to go under contract before you even close on the relinquished sale. That works in a 1031 exchange. You want to make sure the closings are in the right order. We'll talk about reverse exchanges briefly at the end, but that's awfully fast. And if you can get under contract in the 45 days, that's best. It's not a requirement, but you don't want to lose it because the only property that qualifies is property that was identified in the 45 days. And 180 days or the due date of the tax return for the year the property sold is the acquisition deadline. So for instance, if somebody sold in December and their tax return is due April 15th, that's not 180 days. It's shorter than 180 days. But they can file for an automatic extension on their tax return to get the whole 180 days. So the key is if they sold that last quarter of the year, in order to get the full deadline, they want to wait to file their taxes until they complete their exchange. Okay. And the clock for both of those deadlines starts with the transfer of the relinquished property. By midnight of the 45th day, the taxpayer must formally identify the replacement property. And by midnight of the 180th day, they must identify. And again, that 180 days might be shortened. Anything that's selling right now, it will not be shortened unless they're not a calendar year taxpayer. Okay, extensions. A lot of times people ask, well, doesn't my ID, it falls on a Saturday, can I get until the next Monday? No, there are no extensions for holidays or weekends. And as I said, they can get the whole 180 days if they file for an automatic extension on their tax return. I've also had clients call me and say, my husband's in the hospital, he's undergoing surgery, and his 45 days is tomorrow. Can that get extended due to circumstances? And no, the IRS has no authority to extend anybody's deadline except for presidentially declared disasters. So if somebody has a power of attorney, which most people do, if they're going into the hospital, they should have somebody sign that ID form under a power of attorney. So disaster extensions, the first ones that were offered were in 2001, 9/11, and travel was disrupted. Everybody in the country got to take advantage of an extension. Now most natural disasters, floods, hurricanes, wildfires, there will be a notice on the IRS website that tells who an affected taxpayer is in a particular disaster. And in most cases, they get an extra 120 days on either the ID or the acquisition deadline or both, depending on the circumstances. And it'll define it in the notice. For COVID-19, they did not give as broad an extension, which was really surprising in the industry. They only gave an extension for anybody who had a deadline. So it was either the 45 days or the 180 that fell between April 1st and July 15th. Those deadlines got extended to July 15th. So if your deadline was July 14th, you only got a 1-day extension. It was crazy, but that's the only deadlines they gave. I'm sorry, the sun's in my eyes. I may try to move a little. There we go. That did it. Okay. So what is a like-kind exchange? The section 1031A1 right here is the nuts and bolts of a like-kind exchange. No gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such property is exchanged solely for real property of like kind to be held either for productive use in a trade or business for investment. So let's look at what that means. There is an exchange requirement. It has to be exchanged. It's not a sale and a purchase. And the way that's accomplished is through the qualified intermediary safe harbor. And that's what we at Investors Title do. We serve as the qualified intermediary in the transaction. We'll talk more about what that entails in a minute. So there is this exchange requirement. There's a qualified use requirement. The only property that qualifies is property that's investment property or property productively used in a business or trade. So if I own an office building or a restaurant that I operate my business out of, that is property used productively in my business or trade. But if I own a rental house or triple net lease property, then that's investment property. And those qualify.
Can I ask a question?
Yes.
What if can you sell an office space and then use that money to buy residential investment properties?
Yes.
You can. So there's.
And that's a perfect lead into my next bullet point here. Like kind. Real estate is the only thing that qualifies, and the use does not matter. So as long as it qualifies as either productive use in a business trade or for investment, it's like kind of any other real estate. So you can exchange let's say a warehouse for an apartment building. or for a bunch of rental houses. We've seen people sell hotels and buy rental houses. We've seen people, like I said before, sell raw land and buy rental houses or commercial investment property. So it's wide open. A lot of people have the misconception that the use has to be the same. We had a client years ago that had a B&B that she was selling. And she said, so I have to buy another B&B, right? No. Any investment real estate or real estate that you're using in your business or trade would qualify.
Can I ask one more question while I have your attention?
Sure.
You know, the example that you gave before, how this person had the $150,000 house, they sold it, and then they reinvested it into 3 other homes and so forth. What if at some point, you know, they are going to sell everything, right?
Yes.
Now, what capital gains are you going to be paying those taxes on? The initial 150 that you kind of reinvested? I'm just trying to gather that.
Yes. So what happens when a taxpayer does a 1031 exchange, they file with their tax return a report on Form 8824. And that will calculate what their new basis is in the replacement property. So let's say I originally bought a piece of property for $100,000. And now I'm selling it for 150. And let's just say it's raw land, it hasn't depreciated, no improvements. So I have 50,000 gain in that property, right?
Mm-hmm.
Let's say I buy a new property for 200,000. Normally, when I buy property, the basis is the purchase price. But in this case, I did a 1031 exchange. I deferred 50,000 of gain. So my basis in this 200,000 piece of property is going to be 50,000 less. The amount of gain I deferred reduces the basis in the new property. So now that property has the 200,000 piece of property I bought has 150,000 basis. So that 50,000 gain is built in. And if a subsequent exchange, that gain continues. Each property, you've got a new adjusted basis of that property when you acquire it. So the gain is still built in. When I eventually sell, I will recognize not only the gain since I bought it, but the prior gain that I deferred.
And if you've taken depreciation on anything, now at this point, that also
reduces the basis. And if I make any improvements, that raises the basis. So clients should always be talking to their CPA to determine what their basis, their adjusted basis is when they sell.
Thank you.
Question. Thank you.
But all that gain, if the owner dies and it passed 2 years, doesn't matter anymore, right?
Yes, and I've forgotten what the threshold is, but I think it's 5 million. It might be 10 million in gain that can be deferred by an estate. So yeah, the heirs would inherit the stepped up basis under current tax law. If that changes in the future, might be a different story. Okay, going on. So as we said, property held for investment or productive use in a business or trade. Here's some kind of real estate that will not qualify. Property held primarily for sale. So that includes dealer property, flips. Okay, if somebody buys a property knowing that, oh, I can put $10,000 into this property in minor repairs and sell it for 50,000 more. They did not acquire that for investment. They acquired it for the primary purpose of sale. And that does not qualify. That's considered inventory. There was a question up until 2008 about whether second homes qualified or not. And in here, Carolina, we saw a lot of people selling beach houses, mountain houses, second homes, and doing a 1031 exchange. Some court cases came out in 2008, and the IRS issued a safe harbor for when residential property qualifies. And here are the rules. This safe harbor says, and what a safe harbor is that if you follow these rules, you can be sure that it will qualify. And it said, even though a taxpayer may use it sometimes for personal use, here are the rules to make sure it will qualify. The relinquished property must have been owned by the taxpayer for at least 2 years. So there aren't many holding periods in Section 1031, but this is one of them. So if your client is selling a residential property, if they've owned it for 2 years, and during those last 2 years, they have rented it out for at least 14 days each year, that's not a whole lot of rental. But they've also limited their use, their personal use, to either 14 days or 10% of the number of days they've rented it. So if they've rented it for 300 days, they get to use it for 30 days. But if they follow these rules, it will qualify. Great planning opportunity. If somebody has a beach house that's been in their family for years, it's got a lot of built-in gain, and they've decided they want to sell it. If for 2 years prior to listing it, they follow these rules, then they can do a 1031 exchange on it. It also applies the same rules to the replacement property. So somebody's selling a rental house, they're buying a new property, and as long as for 2 years they follow those rules, they rent it out for 2 weeks a year and limit their personal use to 2 weeks a year, then after the 2 years is up, they can move in and make it their principal residence or a second home or anything, and it does not trigger gain recognition at that point. So we see actually a lot of people, especially who are getting ready to retire and they're selling a business property, do a 1031 exchange, acquire that dream house at the beach, rent it out for 2 years. They don't have to trash it in a permanent rental program. They just need to rent it out at fair market value for 2 weeks, each of those 2 years, limit their personal use, take depreciation on the property during those 2 years. Then they could move in and make it their principal residence. Then after they've lived in it another 2 years as their principal residence, if they sell it, they get to exclude for a married couple $500,000 of gain. So even the original gain from the sale of their business property could end up being excluded. There's a little bit of recapture on the period that they took depreciation, but it's still an excellent planning tool, and we see a lot of people doing that. So
Yeah.
Yes.
Can I ask you really quick, back to flips, is there any time period they need to keep it to avoid paying the capital gain?
Well, if it's a residential property, they'd need to follow that safe harbor. So if they buy a property, renovate it, and then rent it out for 2 years, then it would qualify.
Okay.
Another kind of property that a lot of people are unclear about, and it's a misconception, dealer property includes a developer who buys a tract of land, subdivides it into lots, and starts selling off lots. That's inventory in their hands. Even if they're just selling off lots, it's inventory, not eligible for 1031. If it's a builder that's bought lots, built and selling, again, inventory, not eligible for 1031. So real property is very broadly defined for like kind. As we said before, you can exchange out of even a tenant in common interest for fee simple interest. A lot of people do 1031 exchanges on easements. So they may sell a conservation easement and use those proceeds for income producing property. So it's a very broad definition of like. To get, and here's one of the interesting things that I think it's good for folks to know. How do I make sure I defer all of my gain? And the napkin test is the greatest thing in the world because it's so simple to explain. I want to trade up or equal in fair market value. So if I sell for 500,000, my goal is to buy replacement property worth 500,000. I haven't cashed out of my investment. I've completely gotten new property worth just as much as my old property. I'm in the same shoes. The second prong to this test is trade up or equal in equity. And here's where some of the confusion comes in. I'm selling a piece of property for 500,000. At closing, a $200,000 mortgage gets paid off and 300,000 equity goes to the qualified intermediary. I've got to use all that equity. I have to trade up to 500. I sold for 500, but I need to also make sure that all that equity goes as equity in the property. The bank may say on the new property, we'll give you 80% financing, but I'm not using my whole 300 that way, or they'll say 90% financing. You want to make sure that you use all the money that the QI is holding, the net sales proceeds from the sale, as equity in the property, because just think about it. If you take a loan that's too big and don't use all that money, what happens to the extra money? The taxpayer gets it from the QI at the end of the exchange, and that is taxable boot to them. So they want to make sure that they use all of their net sales proceeds as equity in the new property and trade up or equal in value. And here's, they will recognize gain in the amount of the greater of the trade down in value or the trade down in equity.
Can I ask a question? Do they,
Yes.
is there a penalty involved if you take any of that, if you do take any of that gain, or is it just the taxes paid?
Just the taxes paid.
Okay.
No penalty. Okay, great questions. So here are some of the common misconceptions we see. I only need to reinvest my basis. I bought that property that I'm selling for 500. I bought it for 250. So I only need to reinvest the 250. Well, that's wrong because they're getting all their gain that way. The other one is I only need to reinvest my equity. Example I just gave, they sold for 500, 200 got paid off at closing, 300 went to the QI. They think that's my shopping money. I just need to buy 300. But that's wrong because they've cashed out of their investment in the form of paying off a loan. It's as if they got that money and used it to pay off the loan. So some people say, well, I'm deferring recognition of gain. I sold this property for 500,000. I've only got 200,000 gain. So I just need to buy $200,000 worth of replacement property. Wrong again. So just remember those simple rules: trade up or equal in value and use all the money that the QI is holding as equity in the new property. Don't take a loan that's too big. Some items on a closing statement might create a little bit of taxable boot. We call boot. Boot isn't defined anywhere in the tax code, but it's what in the industry everybody calls the taxable portion if an exchange has some taxable consequences. So some items may create boot, and sometimes it's inconsequential, but sometimes it's large. And so this is sort of a red flag you might want to have them talk to their CPA about. Prepaid rent, security deposits, prorated property taxes. These are not expenses of selling property, even though on a settlement statement, you might, let's say the seller has gotten security deposits of $10,000 from renters. They're selling. Typically, if it's not a 1031 exchange, you would just credit the buyer with $10,000 so that you don't have to come out of pocket to give them that money. But in a 1031 exchange, that's taking $10,000 of the sales price and paying it out of exchange proceeds for something that's not an exchange expense. They should be bringing that $10,000 that they're holding in a special account. They should be paying that directly, either outside of closing or bringing that $10,000, depositing it into closing, so that the whole sales proceeds from the house goes to the QI. Same with prorated property tax credits. Usually, especially if it's just a rental house or something, the number is so small that it's not going to make a significant difference in their taxes. But if it's a large commercial property, we typically see them paying that outside of closing. Earnest money. So on the relinquished property, seller has taken earnest money and due diligence that is part of the sales proceeds. If they keep that, it could be taxable boot. But if they take it back to closing, deposit it in closing so that it goes to the QI, then it's not taxable boot. So it's okay for them to take that check and cash it. It doesn't create a problem as long as they send it back to closing or have the closing attorney hold those funds so that it becomes part of what's sent to the QI. On the replacement property, same thing, sort of different. If they're putting earnest money down on replacement property and the QI is already holding the funds, then they can ask the QI to disperse the earnest money. But if the QI doesn't have any money yet to disperse, they can pay that out of pocket. And at the end of the exchange, if they end up getting that much money back, it's offset by what they previously paid. So it wouldn't be taxable. Also, some clients want to just do a partial exchange. And they've decided, yes, I'm selling for $1 million, but I need $50,000. And I know that I'm going to get taxed on the $50,000 taxable boot, but I just need that cash. And I'm deferring $450,000 in gain recognition. I'm okay with paying taxes on 50 of it. They can take that money at the relinquished property closing, and we just recommend that the settlement statement clearly show what went to the QI and what went to them. Once it's in the QI's hands, it's subject to those restrictions on when they can get it back. So they'll have to wait till the end of the exchange period to get any funds back. And any funds they do get back at the end of the exchange is taxable boot. So what exactly is the QI? It's an exchange partner. And under the regs, the taxpayer relinquishes his property to the qualified intermediary. This is done in the exchange agreement. It's just a paper fiction, because no deed goes to the QI. Just they say in the exchange agreement, QI, I'm relinquishing my property to you. The QI transfers the relinquished property to the buyer. Again, a paper fiction. But that's why the contract for sale has been assigned from the taxpayer who's selling the property to the QI. so that the QI is the contractual seller of the property, even though the deed goes directly from seller to buyer. It's a paper fiction. A paper trail has to be in place. The QI then is the only party entitled to receipt of the funds because the taxpayers relinquished his rights to receive those funds to the QI. QI holds the sales proceeds. The QI acquires the replacement property for the taxpayer. Again, a paper fiction, because the taxpayer is going to go out and enter into a contract to buy the replacement property. But they're going to assign that contract to the QI. The QI then transfers the replacement property to the taxpayer. And again, paper fiction. It all happens in the exchange documents. So the closing is going to look like any other closing. Deed goes from seller to buyer for both properties. There just has to be this paper trail in place, and direct deeding is allowed. So who is a QI? It can't be a disqualified person, and those are defined as an agent of the taxpayer, not a related party, blah, blah, blah. But one of the people recommended in the regulations is a title company. And that's why most title companies offer QI services, including investors title. It's interesting that the QI safe harbor came out in 1991. Investors title has been offering this service since 1988. So we've been ahead of the curve all along. I'm trying to move this where it's better. So you want to make sure that the QI, and we highly recommend our own services, of course, has the experience, reputation, and service. We have handled thousands and thousands and thousands of exchanges. We've handled typically between 150 and 200 exchanges, new transactions every month. And like I said, we've got 11 people on staff. So we draft the documents, we docket deadlines, we give deadline reminders to our customers, reasonable fees. We cannot give tax or legal advice, even though Victoria and I are both attorneys. We cannot give tax or legal advice to our customers. But we can, educate them on the general rules. We just can't apply those to their transaction. So oftentimes we find ourselves formulating the questions. If we see a problem, if we see a red flag in a transaction, we say, you need to ask your CPA this question. And we'll send them articles on point, et cetera. So our knowledge and expertise is valuable. There's just a fine line. We can't give tax or legal advice.
I'll add a little plug in for Investors Title and Carol and Victoria. I literally just closed one last week. It was a 10-day cash. It was a really quick turnaround, and you guys were absolutely amazing. Made it so simple for everyone, answered questions. And what could have been a stressful situation, everyone felt supported. So thank you guys. You guys are awesome.
Thanks for the feedback.
Yeah.
We appreciate that. Yeah. And so, of course, security of funds is our highest priority. We do have interest-bearing accounts for our customers. We have fidelity bonding insurance in place to protect funds. We've got independent auditing. Qualified trust is available with our trust company, although that's seldom needed. So let's just look at what needs to be done. Prior to the relinquished property closing, you want to send an order form to the QI. Okay, and it's important that this is done prior to closing. I don't remember how much notice we had from you, Pam, but we request at least 5 days notice. Sometimes we get calls from the closing table. where the parties have just discovered that seller wants to do a 1031 exchange.
Oh, I did better than
We
that.
will drop everything. Yeah.
That's kind of stressful. though.
So,
Yeah.
we do charge $100 rush fee for those same day orders, but we bend over backwards to get it done. So send us an order form and a copy of the contract for the sale. Then we draft the documents. At the relinquished property closing, the exchange docs are executed, authorizing direct deeding, and the closing attorney sends the signed documents and the sales proceeds back to us. And by the way, after this presentation, I will send Pam, and you probably already have it, copy of our order form, a copy of this PowerPoint presentation, a copy of a checklist that we've developed for our customers to show them what they need to do at each stage. So we hold and send the funds to the closer. And at closing, the docs are executed, direct deeding again is authorized, and the exchange is complete. ID rules are really important for you guys. How many properties can be identified? What are the rules for IDs? It has to be in writing, signed by the taxpayer, sent to the QI by midnight of the 45th day. Property that's actually closed on within that 45 days, they've actually acquired it, they don't need a formal ID. But it does count as an identified property. It's deemed identified. So most people use the 3 property rule in determining how many properties they can identify. Up to 3 properties can be identified. The sky's the limit in value. So if they are identifying alternate properties, or if they desire to acquire all 3, it doesn't matter. And the sky's the limit with value. If you identify more than 3 properties, the 200% rule applies. And that says that all the identified properties, the cumulative value cannot be more than double what the relinquished property value was. So we see this, for instance, if somebody's selling a large property like a hotel and buying 12 rental houses, and it's not more than double what the hotel sale was, but they can identify as long as it doesn't exceed double what they sold for. The 95% rule is rarely used. I've only seen it used a handful of times. And it says if the 200% rule has been violated, the ID is void. But if the taxpayer actually acquires 95% of what they identified, the ID is salvaged. The rare cases I've seen this used is if they are buying, let's say, 4 properties, and those 4 properties are worth more than double what they sold, but they're all being acquired under one contract, 4 distinct parcels from one seller under one contract, then they're sure that they're going to buy all of that. But if you identify 5 properties and you only buy 4 of them, you might be out of luck. So that 200% rule is better to rely on than the 95% rule. And so the last thing I'm going to talk about is just briefly mention, I'm not going to go into depth into any of these, but these are red flags that you want to watch out for. Related party exchanges. Related parties can swap directly with each other, but then they each have to hold on to their properties for 2 years. What is a problem is selling to an unrelated party, you're doing a 1031 exchange, and buying property from a related party. That has been ruled against. It's a big problem in 1031 exchanges. So typically you do not want to buy your replacement property from a related party. There are a few exceptions to that rule, but they're rare. And if you want more information on that topic, we've got some newsletters on our website that you're welcome to either access there or call us and we'll send it to you. But that's just a big red flag, related parties. Another one is seller financing. It does not mesh well with a 1031 exchange. Seller financing is an alternate way to defer recognition of gain over the life of the note. But if the taxpayer receives that note, it's considered receipt of cash, just like a check. And so there are ways to deal with that, but the taxpayer generally has to have cash to either fund an arm's length loan to the buyer or to buy the note from the QI at the end of the transaction. So seller financing is another red flag. Partnership issues are one of the biggest red flags we see. And when I talk about partnerships, that includes a multi-member LLC, which is generally taxed as a partnership or as an S corp. So any entity can do an exchange. A partnership that owns property can do an exchange, and the partnership acquires other property. Where we run into problems is the misconception that partners have. ABC Partnership has Mr. A, Mr. B, and Mr. C as partners. They're selling real estate. Mr. A wants to do an exchange, Mr. B and Mr. C don't. Well, Mr. A thinks he owns a 1/3 interest in that property, but he doesn't. He owns a 1/3 interest in the partnership, which is a personal property ownership. He does not own real estate. He owns a partnership interest. So the partnership could do an exchange, but an individual partner can't. There are tax attorneys that will structure what's called a drop and swap exchange, where they terminate the partnership, distribute the property to the partners as tenants in common. Now Mr. A owns a 1/3 interest in real estate and he can do an exchange. This issue is very complex, and typically that drop has to occur before they enter into a contract for sale. So that's really something that you need to look out for, and they're going to need a tax attorney to structure that. And multiple relinquished properties. The taxpayer needs to decide whether they want to structure it all in one exchange. And if so, the deadlines start with the first sale, or if they want to separate it into separate exchange transactions. So they'll need to let the QI know that up front. Typically, whoever owned the relinquished property has to take title to the replacement property. This is a taxpayer-specific transaction. So if Carol Hayden owned property by herself, sells it in a 1031 exchange, and acquires my replacement property with my husband, only half the value of that new property is going to count towards my exchange. Okay, so husband and wife issues are big. An exception is disregarded entities. So a single member LLC is disregarded for tax purposes, as is a Delaware statutory trust interest. So if Carol Hayden sold raw land in my own name and acquired as replacement property in Carol Hayden LLC, because this is income producing property, I need my limited liability protection. As long as it's a single member LLC, that LLC is disregarded and I can take title in that entity. And then the last red flag, two of them really, is construction of replacement property. Any construction completed after the taxpayer acquires title does not count towards the exchange. And that's a big misconception clients have. They think, oh, I can identify this land, close on it, and then use my QI funds to build on it. Well, no, it won't qualify because he's purchasing construction services, not real estate. So the real estate has to be already improved when he takes title. There is a parking transaction safe harbor where an exchange accommodation title holder, and investors title offers these services, takes title to the property during the replacement property, the target property during the construction phase. And within the 180 days, as much improvements as possible are used using the QI funds. And then at the end of the at day 180, we would transfer the property to the taxpayer as completed for their exchange. It's a much more complex transaction. Victoria handles most of those transactions. It's much more complex. It's more expensive. Our fees range anywhere from $6,000 to $10,000, depending on the complexity of the transaction. But it is something that's possible. Also, if they're buying property that's, let's say a builder owns it, and they're not going to close until it's complete. When they identify it, if it's not complete, they need to also specifically identify the improvements that'll be in place when they acquire it. But that would not be a parking transaction if the builder owns it and is just selling it to them. And then reverse exchanges are the last big red flag. If they have to acquire their new property first, then again, this is a parking transaction. They need to enter with us as the exchange accommodation title holder, a QEAA, Qualified Exchange Accommodation Arrangement. We park the replacement property until the relinquished property sells. The biggest issue is that we're not going to come out of pocket to buy this property. So the taxpayer either needs to guarantee a loan or loan us the funds. And we triple net lease the property back to the taxpayer during our ownership so that they can be in possession, occupy it, whatever, use it for whatever purpose they are using it for. And both we and the taxpayer have to report it on our tax returns. They identify what they're selling within 45 days. They sell with the relinquished property. The money goes to a QI like a regular exchange. Then they have a third closing where they acquire the replacement property that we're parking. So that's a complex transaction. Again, much more expensive, but possible. We charge starting at $4,500, $5,000 on top of the QI fee for those transactions. So I'm going to stop sharing. Okay. So any questions as we wrap up?
I've got a quick question. Can you buy from one LLC and then purchase or 1031 in another, or is that does it fall back under the same taxpayer?
It's the same taxpayer, but if they're both disregarded entities, that works. So let's say I'm selling property and the property is entitled in 123 Main Street LLC, property located at that address. And I'm the only member in that LLC. It's a disregarded entity for tax purposes. I can sell that and I can buy my new property in an LLC entitled 265 Oak Street LLC. That is also a disregarded entity and I'm the sole owner of that. But if it's a multi-member LLC, it has to be the same LLC that sold that acquires the new property.
Is that the same with the S Corp or is that just for LLC?
Same with an S Corp, same with an S Corp. Same taxpayer that sold has to acquire. Because it's the taxpayer that sold that is reporting the 1031 exchange and saying, I've acquired replacement property. But if some other entity acquires the replacement property, even if it's got the same members in it, then it wouldn't qualify. So what we see a lot of is that even a partnership or an S Corp may hold property in a single member LLC of which their partnership is the sole member. And that way you could have separate LLCs for each property, single purpose entities.
Thank you for that.
Yeah, great question. Anything else?
I think my takeaway
Well,
is call Carol or call Victoria, call Investors Title when you're trying to talk about and negotiate with a 1031. It's important to have great vendors and people that know what they're doing, you know, to help everybody get through the transaction. So that's my takeaway.
Okay, well, we're happy to help you and call us anytime. Thanks for your time.
Thank you, Carol. It was amazing today. Such great content. We appreciate it. Thank you.
You're welcome.
Now we just
Bye-bye.
Contact information. Thank you, Carol.
You're welcome.